The content presented in this podcast is intended solely for general informational and educational purposes. Nothing herein constitutes or should be construed as financial, investment, legal, or tax advice. You should not act or rely on any information in this podcast without seeking the advice of a qualified financial professional.
This audio/video podcast is an AI-generated product produced using Notebook LM. It automatically summarizes and synthesizes reports, analyses, and commentary originally published at reflectionsofreality.substack.com. All views, opinions, and analyses expressed are those of the original author and do not represent the views of any financial institution or regulator. Past performance is not indicative of future results. All investments involve risk, including possible loss of principal. Copyright Reflections of Reality, all original content rights reserved.
All right, welcome to The Explainer. Today, we've got a fascinating roadmap for decoding this incredibly complex market environment. We're going to cover 5 key areas. First up, 2 lenses, 1 horizon. Then, we'll look at Polymarket versus the tape. Third, we'll dive into the Convergence verdict. Fourth is institutional rotation. And finally, we'll wrap up with executing the swing books. Let's just jump right in. Okay, part 1, 2 lenses, 1 horizon. Let's set the premise for what we're actually doing here. We're diving deep into the Convergence brief, which is essentially a powerful analytical funnel. Think of it like this. We're taking 2 completely independent ways of looking at the market and smashing them together. On one side, we have Lens 1, the Polymarket macro monitor. This gives us a probability-based, forward-looking view of how the crowd is pricing in massive regime shifts. On the exact opposite side, we have Lens 2, the weekly report. This is our measurement-based reality check on the current cycle, reading real-time institutional tape flow, forward expectations versus current reality. It's an incredible framework.
Moving right along to part 2, Polymarket versus the tape. Let's see what each side is actually saying right now.
Starting with the crowd's view through Lens 1, Polymarket is painting a very distinct, risk-heavy picture. Bettors are heavily pricing in a hardened, higher-for-longer Fed regime alongside a material energy premium tied to disruptions in the Strait of Hormuz. But here's the real kicker. They are expecting massive concentration in NVIDIA and AI, giving it a staggering 89.5% odds of market dominance. Meanwhile, the crowd is bracing for total crypto capitulation.
But hold on. What is the actual tape doing right now? To answer that, we absolutely must define our baseline using a proprietary indicator called the MDI, or Market Dashboard Index, which measures overall market sentiment. Historically, the 10 to 35 range is the bullish mean reversion zone, but the 50 to 65 band, that is the bullish kickoff zone. Historically, the best risk-adjusted zone for swing traders as volatility begins to fall and the trend reasserts itself. This week, we are sitting right at 51.0, so technically, we are in a bullish kickoff with an average one-week return of about positive 0.71% and a 63% positive hit rate. But here is the massive catch you need to pay attention to. Positioning flows have not yet confirmed this.
And that brings us to health. This is another proprietary term you'll hear us use today. It measures market breadth based on a machine learning flow model. When health is high, we've got broad trend confirmation. When it's low, it means there's serious divergence risk lurking just beneath the surface. This is where the narrative completely fractures. On the surface, we have a headline Goldilocks regime that looks incredibly strong at 70.6%. Everything seems fine, right? Wrong. The tape reveals a severe breadth crisis. Our empty_health indicator has plummeted to just 40.9%. So while the surface-level index might look totally fine, broad participation across the market is actually collapsing. It's dangerously thin out there. Let's move to part 3, the Convergence verdict. This is where we look for our edge. Let's look at exactly where these 2 lenses align and where they violently clash. On the Fed, we actually have strong agreement. Polymarket is anchored on higher for longer, and the real-time tape confirms this, with the MVI deeply negative. MVI, or the Market Valuation Index, measures how attractive stocks are versus bonds after adjusting for the business cycle. It shows the cyclical equity risk premium, not raw valuation. High or positive readings mean stocks are cheap and rewarding relative to yields. Deep negative readings mean stocks are expensive and risky relative to yields. Right now, SPY is at negative 0.69, and IWM is significantly lagging at negative 1.23, which is a major risk-off signal. So both lenses agree, rate relief isn't happening. But look at energy. Polymarket is pricing in a material Hormuz premium, which should mean massive buying. Yet the tape shows the energy sector, XLE, is only rotating in. It's not seeing actual institutional accumulation. That is a glaring disagree. The smart money isn't buying the crowd's fear. Now check this out. Because this exposes the most aggressive disconnect on the entire board. Polymarket is utterly convinced of AI concentration, giving NVIDIA an 89.5% dominance probability. But the tape is ruthlessly rejecting that narrative. The QQQ is in severe liquidation, seeing a massive negative 48.8% one-week flow. When the crowd screams buy AI, but institutional flow is literally screaming sell, you have to respect the tape. On the flip side, safe havens align perfectly. The crowd's geopolitical tail risk fears are meeting actual institutional bids in treasuries and utilities.
All right, part 4, institutional rotation. We need to map exactly where the flows are going.
Before we look at the map, let's strictly define our 4 proprietary rotation states. Accumulation means institutional buying or inflow. Rotation in indicates improving momentum where we're entering a bullish phase. Rotation out means fading momentum and profit-taking. And liquidation? That is outright institutional selling and outflow.
And this brilliantly illustrates the profound macro paradox we are living in right now. Despite those textbook Goldilocks economic headlines we talked about, the dominant market state is actually rotation out at 16.3%. The macro setup is begging for a broad rally, but institutions are actively taking profits and fading the momentum.
Which brings us right back to the glaring NVDA convergence gap. The forward odds are absolutely stacked on AI dominance. Yet, the real-time tape shows the QQQ, VGT, and the broader SPX in a systematic institutional exit. We are seeing a massive wave of liquidation right where the crowd happens to be the most bullish. That is a massive flashing red flag for anyone paying attention.
Finally, part 5, executing the swing books. How do we actually translate all of this into action?
Because our market health indicator is deteriorating so rapidly beneath the index price, our executed books have to be postured defensively. The KISS portfolio is sitting in full cash, patiently awaiting a true accumulation trigger. The Beacon 1 portfolio is highly defensive right now, and the MAGS_D portfolio, 100% in cash. Listen, when MT_health drops down to 40.9%, capital preservation absolutely becomes the primary directive.
In a highly contested tape like this one, we don't guess. We rely heavily on our most robust signal, the triple play. This is our highest conviction filter. To trigger, it demands the high conviction alignment of 3 legs simultaneously. First, our bull percent indicator for positioning and flow trend. Second, the frontier options positioning oscillator. And third, sentiment, measured by the call-put ratio. When all 3 of those align perfectly, we have a triple play, a very strong signal that institutions are fully committed.
When we apply this framework to the current market, it paints a very stark contrast. On the absolute cleanest end of the spectrum, names like Union Pacific and Caterpillar are showing true accumulation with full triple play alignment. They have the real money behind them. But on the exact opposite end, heavily exposed names like Macy's are stuck in severe liquidation flow, fighting a painfully negative tape and completely contradicting any crowd optimism.
Ultimately, the data simply doesn't care about the crowd's favorite narrative. When forward probabilities from the crowd and real-time institutional tape flows collide, the tape is always going to win. So as you review your own portfolio after watching this explainer, the absolute most critical question you have to ask yourself is this: are you riding the wave of real institutional accumulation, or are you left holding the bag for a crowd whose thesis has already been liquidated? Thanks so much for tuning in.